Good evening, ladies and gentlemen. We welcome you all to this comprehensive workshop on Companies Act 2013. Today we have with us CA Ravi Prasad T and CA Sri Lakshmi P to address on Management and Administration Dividend and the Companies Act 2013. May I request CA Allama Prabhu, Secretary of our Bangalore branch, to escort our workshop coordinator, CA Guru Rajacharya, and our speakers of the day, CA Ravi Prasad and CA Sri Lakshmi, onto the dais. I also request CA Allama Prabhu to formally welcome our speakers with floral bouquet. Thank you, sir. I take this opportunity to introduce our first speaker, Ravi Prasad. Ravi Prasad has undergone his articleship in MSSV & Co. and later joined as a partner and looks after company law matters and audits, and is also handling service tax and income tax up to first appellate level. He is presently one of the members of Financial Report Review Group and was co-op member of Corporate Law Committee and Accounting Standards. With this brief introduction, I once again welcome you, sir. I take this opportunity to introduce our second speaker, Sri Lakshmi. She has so many feathers in her cap. She is a chartered accountant, company secretary, and has done MSc Psychology. She has worked in BMR Advisors for 2 years and currently partner at Guru & Jana, heading the team of corporate governance. She has contributed articles in a self-help growth magazine. With this brief introduction, I once again welcome you, ma'am. Now, I hand over the session to our session coordinator, C.A. Guru Rajacharya.
Good evening, one and all. Today, we have come to the 5th day of our workshop, the last day where we meet on the evening. Now, tomorrow all of you are aware that we will be meeting at 9:30 in the morning. So please set your alarm clocks accordingly. Tomorrow we will be talking on audit for the first 2 hours, chapter 10 that is on the Companies Act. And then later in the second part, we will be going into the open house discussion. What I would suggest all of you is kindly give your questions, if at all, in advance so that we can come prepared to answer that. Otherwise, we will definitely answer, but we can't assure you the perfection in the answer. So if you want a perfect answer, I would always suggest that you give your chit right now so that we can come prepared. Now, talking about today's session, we have one of the vibrant speaker in Sri Ravi Prasad, whom I know for a very long time, whom all of you know for a very long time. He's been talking on taxation, and of late he's been talking on Companies Act. In fact, he has given his long hand to me, or a helping hand to me, in designing this particular course, in designing this particular workshop. So I thank you, Ravi, profusely on behalf of all of you, for helping the branch coming out with such a good workshop. Now, he will be talking on a very, very important topic, that is management and administration. Now, all of you know that for the first time when we talked about Companies Act, whenever we read as students on Companies Act, we were thrilled when our teachers taught us on secretarial practice. Those were in the topic of secretarial practice. What we were very happy was with some particular chapter on when it came to proxy, minutes, resolutions, the day-to-day administration of a company. So today, Ravi will be talking on this particular chapter. It's a very single chapter. He will be talking only on one chapter, which is very important from the day-to-day aspect. So he will be covering management and administration. In fact, he was good enough to share the dais. Originally, the second topic was also given to him. But when we said we wanted a women speaker for the session, and in fact, it was his recommendation to bring in Sri Lakshmi, he was good enough to give dividends to Sri Lakshmi in the form of this particular chapter itself. Now, Sri Lakshmi, as you can see, I think Sundareshan mentioned that dividends is one of the shortest definition in the entire chapter of. I didn't know what he meant by shortest, but certainly we have a youngest member, in the entire workshop of the 18 speakers. We have the youngest member who is going to talk on the shortest definition, which is in section 2 of the Companies Act. We wanted one women speaker for sure amongst the 18, and Mr. B.P. Rao was very, very particular that we need to accommodate junior speakers. Seniors are there for their experience, and he says we have to build in enough database of speakers. And I would say, Sri Lakshmi, we are grateful to you for having accepted this, because talking on a podium like this requires tremendous amount of confidence, which I am sure her qualification, her backing by her seniors, her backing by her partners certainly has helped. But we are thankful to you, Sri Lakshmi, for coming here and addressing us on a very sweet topic. Dividends, as I was telling, is a very sweet return for any investor. So let's see what Sri Lakshmi talks. But first of all, let's request Ravi Prasad to take us through the nuances of chapter 7, that is management and administration. Over to you, Ravi.
Thank you, Mr. Guraj. A very warm good evening to my seniors in the profession, my dear other colleagues in the profession, and my dear friends. It's a privilege for me today to be here sharing this dais. For two persons who are here, I would like to thank them before proceeding. The day I started my articleship, but during my articleship days, I heard one of the speakers who is present here. I tried my best to model on him to a great extent. I was not successful, but I have been still learning from him. I thank Mr. Rajendra Rao, who is present here. I also would like to thank one more person whom I knew when he was writing his final examination. The depth with which he goes to the subject, the intensity with which he tries to understand the subject, still keep us inspired. And that person is none other than the person sitting next to me, Mr. Guraj. I learned a lot from these two people. Before going to the topic, I also would like to thank a couple of people who are present here, because in last 2 years being in FRRB and in AASP of the Institute, I had an occasion of interacting with 2-3 of the very knowledgeable people who have taught me a lot during this 2 years. Mr. Srinivasan, Mr. Manohar Gupta, and I'm hopeful Mr. Nityananda will be coming. We have shared a lot of occasion discussing on balance sheet and Schedule 6 and all those things. A lot of inputs they gave me during these 2 years. Sir. Thank you for coming here to listen to me, sir. If I err somewhere in my speech, I request all of you to give up backing to me so that it will be a proper presentation. I had a problem when I took up this topic, for the reason that when I asked what is the total number of registration, they said it's cost 700. So I was thinking for a 700 is a number, how to go about. Should it be a mass or should it be to a class? Then after a lot of thought, I said, no, today's presentation I'll make it to the mass. And if need be, I'll certainly not forget the class. At any time after the presentation is over during the question hour, whatever your queries is there, I will try to answer those things. So my presentation at times looks to be very basic because I thought keeping in mind the number of delegates who are attended and the kind of interaction day in day out you will have with the Companies Act, I thought I'll be touching upon the basics. Also, wherever there are changes there in the Act, which is a new concept or which is the new sections, I'll certainly dwell upon the time on those sections, touching upon the existing one where there are no changes has taken place. Sundaresan told that he is talking on one section. I am also talking on one chapter. This one chapter, chapter 7, Management and Administration, has got only 35 sections. This 35 section has got 120 subsections and about 19 provisos. There are about 20 places where they have referred the section, in this section they have referred the things to as prescribed or as such prescribed. So there are about 20 places where I have to go to the rules. In these 20 rules, there are about 91 sub-rules covering these 35 chapters. 35 chapters, 120 subsections, 19 places or 20 places were subscribed, provided for. These provided for in turn has covering about 91 sub-rules, 4 provisos and 5 explanations, besides about 12 forms. So this is how the present Act is for you, a chapter containing 35 sections, how widely it has been spread. That's the reason I requested Mr. Guraj, or rather Mr. Guraj, when he made an offer that whether you would like to stand and speak or sit and speak, I thought I would be sitting and speaking for the only reason better, because I had to refer to the Act, rules, the new Companies Act, the forms, so it will be very difficult to standing here and talking. So pardon me if I am addressing you sitting here. This particular chapter has got, just out of the 35 sections, 5 sections which are totally new. Completely new sections are only 5. Rest of the sections have been modified to some extent or retained as it is. There are some of the sections that have been retained as it is. As and when I come to the section proper, I'll tell you about that. The only best part of my chapter is that the chapter 7, what I'm dealing with my chapter means, is that there are 13 sections in this chapter out of the 98 notified sections. There are 13 sections have been notified from this chapter alone. That's a good thing. If after 12 September or after that, if anybody has called an EGM saying as per the 1956 Act, then you are wrong in the sending that notice itself. Because calling a notice under an EGM, the EGM section, section 100, has been operative as per the new provision of the Act. Section 1, I'll be going by section so that the flow can be maintained. I will not jumble up things. Section 88 is the first section of this chapter 7, which is corresponds to the section 150, 51, 52 and 157. It talks mainly about the maintenance of the registers. Every company shall maintain the register of the shareholders, register of the debentures and register of the securities. This is the new additions there. Earlier it is only for the shares and debentures. Now it has to be maintained for the securities also. Earlier you are maintaining the register for shares, it was all mentioned. Now they have expanded it to say that you also have to maintain this register for shares held by Indian, shares held by a non-resident. Though in practice, we used to tell all our clients, wherever it's held by a non-resident, specifically mention that in the share certificate itself. Because share certificate doesn't say how it has to be. you can add on any other things in the share certificate, so that it will be easy for us to recognize how many shares belongs to NRI, how many shares belongs to a resident. In NRI shares also, it used to be possibilities were there wherein you could have a shares issued on a repatriable basis and shares issued on a non-repatriable basis. We also suggested to the companies, we used to suggest to the companies saying that wherever such things are there, you can further split the shares into repatriable shares held by the same person, non-repatriable shares held by the same person. There is no bar on that. So that when you declare the dividend, you will have an easily able to identify it based depending upon the shareholding. Or even when the shares need to be transferred, it will be easy to identify the shares which are repatriable, which is non-repatriable and all those things. Now the Act itself has made it proper saying that wherever it is held by non-resident, you have to have it as separate folio for that. What is the section on, or what is the subclause on securities? What is the securities they are talking about? Section 281 talks about securities of the present Act. Section 2 subsection 81 talks about securities. It says securities as defined in Section 2H of Securities and Contract Act 1956. There, securities are, other than the shares and debentures, also covers bonds. If at all a company is issuing units, anything, any listed securities, which is other than shares and debentures, are covered by the definition of 2H of the Contract Act 1956, Securities and Contract Act 1956. So it is for those kind of securities you have to maintain a register now, which has been prescribed by Section 88 of the 2013 Act. Register of members has to be maintained in Form 1 is what they talk about. Form 7.1 is what they talk about the content of a register of members. I will not go into detail of those forms. Form 7.2 talks about register to be maintained for the debenture holders, for security holders. For debenture holders and security holders, one Form 7.2. For the shares, it is one Form 7.1. This particular holding of shares is also applicable for the prescribed for other companies not having share capital. That is the name of the members has to be maintained. The subsection 2 of this section says about indexing of these registers. Earlier also this provision was there. The only change between that and this is that earlier if it's a 50 member or more, then only the indexing was required. Now irrespective of that, whenever you are maintaining this registers, you have to have an index now. This is a change which is between 56 Act and 2013 Act. What will happen in a situation in the larger concerns when these securities maintaining, whether at all these securities maintaining of these registers can be outsourced? The larger companies are not maintaining themselves these registers. If you see, a lot of depository companies are there who maintain on behalf of, say, Carvey or anybody else, they maintain on behalf of these companies. In such situation, whether it can be said that whether the company is maintaining this register, keeping and maintaining this register, though the section is silent on that, the rule says that as long as it is maintained by the depository and you have got full details of the depository maintained with you, that is a sufficient cause to say that this register have been kept and maintained. The rules also says that each entry in these registers has to be initialed and mention the date of a meeting in which that entry has come. So it is stated in the rules. Earlier it used to be there by default. Now with the rules itself very specifically says that mention the initial has to be done for each line item, not at the end of the page you initial or sign is sufficient. Each line item has to be initialed and has to be mentioned on which board meeting or which meeting such securities have been entered in that register. There has to be maintained the register of members in the beneficiaries. What is this beneficiary? Will come to section 89. I'll explain you about that. But what it said that if it's in the case of a register of index of beneficial owners, as maintained in the Depository Act. Section 11 of the Depository Act says that how it is to be maintained. But if we go to Section 11 of the Depository Act, it says that the register maintained of the beneficial owners as specified in Section 151, 152, 153 of the Companies Act. So that means it again comes back to the section. So that means all those relevant acts, wherever there were references to the old section of the Companies Act, also need to undergo a change. So if beneficial owners register is maintained as per the Depository Act, it's a sufficient cost to have maintained the beneficial interest owners register. A new provision is maintained, stated in this act, saying that the foreign register, that is, if authorized by the article, the company may keep outside India register mentioned in subsection 1, that is the register of shareholders, debenture holders and the securities for those residing outside India. There is a separate rules has been or in the rules has been prescribed how this register has to be maintained. Basically the care, the two care has to be taken in those register is that it's an identical register meant for the shares held by a non-residents. If you are maintaining in those countries, it could be any of the countries, the only main requirement beside all other rules are that it need to be published in the local newspaper, in at least 2 local newspapers, stating that such register has been by name, foreign register of this company has been maintained in that country or that place. The day you decide to not to maintain the foreign register, it's a may maintain the register. It's not compulsory, it may maintain. The day you decide to not to maintain that register, on such date, you have to ensure that all the entries which are there in the foreign register are reflected in the register maintained in India. This is the care has to be taken when you don't have to maintain the register outside India. Every section, my last slide is on penalty, because as Mr. Gururaj has told from the beginning, penalty has been rigorous. For this also, violation of this section, the company and every officer as defined in 2 subsection 60 of the New Companies Act, of the company, officer in default in fact, not officer in default is 260, who is default shall be punishable with a fine ranging from 50,000 to 3 lakh rupees. It's almost 5 times increase of the fine. A continuing failure will attract a fine of 1,000 rupees. The only one point you need to be between the first section and the last section. One is the section where you have to keep and maintain. If you go to the section 1 of section 88, it has to be kept and maintained. But when it comes to the penalty section, the word kept has been removed, it's to be maintained. So you cannot say that the kept registers but entries have not been made will not be a sufficient cause to say that penalty cannot be levied, because it's a deliberate intention to remove the word kept, because it is not necessary just to keep, it has to be maintained also. Maintained means entries have to become in a regular day-to-day entries has to come in that register. So it is, if you don't maintain, the penalty is there. Declaration of beneficial interest is covered by section 89. What is beneficial interest? Earlier you used to have a section 187C, wherein, or rather to make it very simple, put it in a very simple term, when you want to incorporate a 100% subsidiary of a foreign company, one of the situations I'm telling, there could be a lot of other situations. One of the situations to make you understand the beneficial interest, that when you have, this is again not a new section, when you want to have a 100% subsidiary of a foreign company, you know in Indian Act, the company can be formed with the minimum 2 subscribers. And how can you call it as a 100% subsidiary? You need to have a 2 subscribers. In such situation, 99.99% is to be held by the foreign company, and 0.01% or whatever the number of shares it could be, 999 and 1, it used to be held by a person in India or anybody on behalf of that company. So it's registered in the name of me. Suppose I am holding on behalf of the other company, I am the registered owner, the beneficial owner is that company. So this is what 187C earlier was talking about, which is covered by section 89. The beneficial owner and the registered owner, the two differences. When Mr. Harish was in ROC, that's the time I would say that a lot of notices has gone to default in companies, where a lot of companies were formed because in a zeal to form a company, they formed a company. They forgot to file a form required under 187C then. A lot of notices has gone at that time saying that you have defaulted in not filing it. Luckily, he didn't levy the penalty. He gave it time to file those forms wherever there was a lacuna by not filing the forms. So whenever this kind of situation is there, beneficial interests are there, ensure that he follows section 89. In such situation, the beneficial owner within 30 days has to file a form to an ROC saying that, intimate to the company that saying that he is a beneficial owner. The registered owner also, the section 2 of 89 says the registered owner also has to intimate for such change taking place in the ownership. Section 3 talks about company has to intimate within 30 days about this situation of beneficial owner and the registered owners. 7.7 rule, form number 7.4 is the prescribed form for filing by the beneficiary owner. 7.5 is the form prescribed for filing by the registered owner of the shares for this purpose. When I was going to the rules, they say that these forms 7.4 and 7.5 has to be filed in duplicate. This is where I'm not very sure what they're talking about. I think we are all in an electronic era where all the files are uploaded to a written from the MCA portals. What do they mean by to be filed in duplicate? I'm not understanding. Are they mean to say that these forms will not be made e-form, or they just copied? I'm not very sure. My colleague was going to share the dash in the afternoon. He said evening session. He says that it's enter twice. That means you enter twice. That's all. To be maintained in duplicate. Probably this particular rule must have been copied from somewhere. They forgot to say that remove the word duplicate. Pardon, sir? That's 187C. Yeah, that will copy. That's what I said. Once electronic era comes, there is no question of duplicate filing. Probably there's an error to which they may be setting right. As I was telling in the first slides, it's covered by so many sections, so many subsections, so many sub-provisos, explanation, all the things. Added to your confusion will be rules. In these sections, they have prescribed the central government to make further rules also on that. Not only the rules which is prescribed, certain other rules also. One of such rules is that rules of manner of holding and disclosing the beneficial interest and ownership rules. So not only that, there could be some other rules coming in, not just this draft rule. There could be central government may say some other rules also further to these rules which has already been prescribed. Whenever I prepared for the paper, this time my daughter and my wife asked, why is that you are sitting in a dining table and preparing? Always you sit in a study table and prepare. Invariably I have to sit in the dining table because I have to refer to the rules, I have to refer to the old act, new act, forms. So many, where else I'll keep it? I have to have a bigger table. So that's how it is now, the present Companies Act is. The last 2 points to be taken care or to be noted. If the declaration is not made by the beneficial owner, no right on the such care can be enforceable by him. There's a slight change from the old act. They've used the word right. Earlier, the scope has been rather widened now. Such beneficial owner, no right can be enforced now. Earlier, it was only to restrict it to the change in whenever you give a guarantee, only to the limited extent that right was denied. Now, entire right is denied in the new act if the beneficial owner doesn't make an intimation of his holding of those shares. However, the section provides for if the beneficial owner or the registered owner doesn't fulfill any of the conditions, the section provides that as far as the declaration of the dividend is there, it goes on. You don't have to withhold a dividend because certain procedure has not been fulfilled in this beneficial or registered holder requirement has not been fulfilled. So this is a welcome provision. Penalty, 50,000 if you don't inform. So ensure that whenever these companies are formed, wherever the beneficial interests are there, you invariably file the forms. Of course, the penalty in the new sections or in the old sections is under, you go to section 403 where it provides for 30 days. Beyond that, 270 days. If you don't do that, then only penalty provision will come to. First the fees, then the additional fees. If you don't fulfill that days, not that from 30 days the penalty will start, after that only this penalty will start. The other penalty is where because of the 89.3, wherein company need to inform to the ROC the changes by the beneficial owner and the registered owner. In such situation where the second part of the penalty will come, where the company will be made liable to the penalty. At any stage you can stop me and ask the question. I am comfortable with the queries coming as and when also, or in the end also.
19 noted the existing provision of the Act, wherein central government has got single appointed person to investigate the matter of beneficial ownership. Where there is a doubt exists on the ownership or beneficial ownership, the central government can intervene and can investigate the matter of beneficial ownership. Absolutely noted from the earlier section of 1917. Very interesting. Section 91, Provisional Register is operational. This is one of the notified sections of the 98 notified sections. Section 91 is operational. Section 91 has got certain rules like Rule 7.98, 7.81, 7.8, which is not operational. To make this section completely operational, you have to make the rules also operational. So we have got a section which is operational as per the Act, which heavily depends on rules. But the rules have not been notified, it's still in the draft stage. That's how this is done. This section says that the register can be closed in the calendar year for an aggregate of 45 days. Any of those registers, what I mentioned in section 88, the three register basically has to be closed for 45 days, a maximum of 45 days in a year, aggregating 30 days at a time. You can't close those registers for more than 30 days at a time. This Act also provides that this closure of registers is made applicable to private companies. It is there, of course. Now what it says that unless you intimate to all the shareholders of the private companies, you can't close the register for verifications. So if you want to, that 45 days of 30 days, whatever it is that is possible for a private company, provided you are informed to all the shareholders. This is a change from the 56 Act. At least 7 days notice or some lesser period may be prescribed, the saving has to be given. That's for the closure when you want to close it. So that 7 days notice at least. Contravention will attract penalty. The only thing is that one more point to be noted is that because of the rule, it says that the closure of this register, the time when you want to close this register has to be informed through advertisement also in newspaper. Whenever there is advertising, most of the cases is in that particular language or that particular place as well as in one of the English newspaper. So whenever I say advertisement, unless otherwise, it is an advertisement in two papers. This is a very, very important section. Section 92, yet to be notified, annual return. This is where obstacles will be there for us. This is correspond to section 159, 160, 61, 62 of the earlier Act. The form for the annual return is form 7.7, which in its present form runs into pages. When we had our internal group discussion, we saw that form, started seeing that form, because there are any so much of disclosure we need to do in this 7.7, we need the annual return now. A lot of additional information. It is nothing but an annual return. We used to call it annual return. Earlier, annual return Schedule 5 is form 7.7 now, by section 92. Line 1, the second one, rather, very, very important thing. Your Schedule 5 earlier annual return was from a date of AGM to date of AGM. It was between two AGMs, transaction or activities taken place between the two AGMs. The present 92 wants it to be between two financial years. A major change. principal office, principal business activity, particulars of the holding, subsidiary, and associates. The entire act is stressed on associates. So even in the annual return, they wanted to be disclosed of the holding company, subsidiary company, associates. Particulars of the shares, debentures, securities, because of section 88, it comes to about securities, particulars of the shares, debentures, and securities. This annual return has to be earlier 160 was there. You need to file for a company not having share capital also. So don't think that if the company doesn't have share capital, you not have to file annual return. It is applicable for every company. Except exemption is given later on, which I tell you to what extent the exemption are given to other companies. Annual return you need to file for indebtedness. Yesterday when you said that what is it? It is not just a indebtedness to the extent of secured only used to be stated earlier, not all indebtedness. The entire indebtedness, and yesterday in one of the people said that indebtedness is also called John was telling that, even the movable assets are also covered by security in this thing. This need to be registered. So that also will be covered in the indebtedness. Members and debenture holders and changes area, promoters, directors, KMP, look at the details required for. When I say promoters, they are not just mention about promoters, directors, KMP, and changes area. Not only that, including their salaries now, then later on I said you have to state their salaries in all the things. Of promoters, directors, KMPs, attending details of meeting of details of the members, board and various committees. This all has to come not in the board report. Board report separately to come. All these things has to come in annual report now. Attending details of the meeting, details of the members, board, the board meeting, and its various subcommittees. The board will create all subcommittees. Their detail also has to be seen in the annual report now. The only lucky is that because earlier from agent to agent, now it's from financial to financial year. So you have enough time to file this. You have to file within 60 days from the AGM date. So you have enough time to prepare it at least. That's only lucky. Remuneration of the directors and KMP, which refers to section 17 of the Income Tax Act, uniform refer to section 17, remuneration as section 17(1) or 17(2) of the Income Tax Act, that the salaries are compensated as stated. That's what we stated in this particular form, annual return. So you have to see that, ensure that when you prepare an annual return, it's not just an annual return salary, the profit form. Ensure that what is stated in 17(1) also, ensure that what is filed in the income of the director or KMP, that salary will be shown here correctly. So your reconciliation work will be involved now. Penalties, punishment, and compounding of offences of the company, its directors and officers, all the things need to be stated in an annual return. So it is not just a routine filing now. You need to take a representation letter from the management to ensure that all these things are not there before saying nil. Matters relating to certification of compliances, disclosure as prescribed, details of the financial institutions have, after that the last line. After all these things, some of them are already discussed, not said it. Such a
prescribed bill. So it's not an end of an annual return as such. Yeah. Trade creditor, I don't think it's debt. Basically, indebtedness, I look at it should be debt in nature. Trade creditors is towards a trade. It cannot be called as a debt. Any borrowing or a loan, which is at that stage, when you enter into that contract or when the transaction originates, what is the status of that has to be seen. At that stage, it's a borrowing money, it is to be repaid, then it's a debt.
Say, let us take company has taken a security deposit.
Yeah.
Against a property which has let out.
Okay.
Will it fall under indebtedness?
Security deposit against the property, I think so, yes.
Rental deposit,
because
rent
debt,
deposit.
It is again, whatever you borrowed, whatever your name you call it, is nothing but I borrowed the money. You may
this is, I have
no,
not
no,
borrowed.
okay, I'm sorry. You are doing security deposit against the property letter. No, it is against a transaction. According to me, anything borrowed towards the transactions will not cover under the debt. Anything borrowed at the stage of the borrowing itself as where there is the intention to repay is there. That's what I look at it as a debt. Not all other things or security deposit or retention money remaining in your balance sheet is not to be looked at as a debt. Once all these informations are filled in the annual return, who will sign the annual return? Annual return to be signed by a director and a company secretary, and where there is no company secretary, by a practicing company secretary. This is applicable for all the companies. Note, it is not annual return to be signed by the director alone. Now, it should be annual return to be signed by the director and a company secretary. Where company secretary is not there, by a practicing company secretary. A change it is. For one-person company and small companies, if company secretary is not there, then to be signed by the directors. So only for these companies, OPC and small companies, the existing provision of signature will remain by the director alone. Where company secretaries are not there, they are not insisting on CS of practice to be assigned by, annual return to be signed by CS in practice. Then they get into a very, very interesting situation in 92. One is an annual return to be filed by every company. And then they come, first is that, then they say that who will be the signatories. There they made this provision. They said that prescribed companies and listed companies, annual return to be signed by the company secretary in practice in the prescribed form. So, the prescribed companies, listed companies anyway need to be signed by the company secretary in practice. The prescribed companies. So, besides this OPC and small company, there has been third class of companies. The prescribed companies, company secretary has to compulsorily sign this annual return. What are these prescribed companies as per the rules? The prescribed companies for this annual return or section 92 are those companies whose capital is, paid up capital is 5 crore or more, and turnover, only two criteria. The paid up capital and turnover. Turnover of 25 crores or more. So 5 crore or more and 25 crores or more are the prescribed companies whose company's annual return has to be signed by the, compulsorily signed by the company secretary other than the listed companies. Let's go to the very interesting situation now. The very earlier provision says that this is not applicable, that is, signing compulsorily by a company secretary is not applicable for small companies. Who are small companies? Small companies are those companies whose capital is, it's used the word or, we had that discussion, 50 lakh, or it can go up to 5 crore. Between those, anyway, or prescribed, I can go up to 5 crore, or turnover of 2 crore, or up to 20 crore. So remember, it's just now one, I'll give you one situation. Remember the small company definition, 50 lakh to 5 crore, up to 5 crore, or 2 crore to 20 crores. That is the small companies. Who is a prescribed company? 5 crore or more, and turnover of 25 crores or more. So I'll give you three situations now. This could also at great extent answer our query, who is a small company, how to look at the word or in small company. You know, other day we had a discussion, if the turnover increases to a substantial level, but the capital still remains below that 5 crore, whether it's still a small company, I always tend to agree with the Guracharya on this issue, though in our group we had a difference of opinion. Now that situation we will put into this, remembering that for small companies, company secretary signature is not required. Practicing company secretary signature is not required. That's what the section says. Before coming into the situation I'm going to tell you, should we have to look at in another way? Yes, the Act says that it is not applicable for a company, company secretary signature is not required for a small company. But if that small company comes into a prescribed company, then company secretary signature is required. Whether it has to be looked in that way or no. Small company, anyway company secretary signature is not required. It's only for the prescribed companies. I'll give you three situations. Situation one, where I got a 5 crore turnover, 5 crore capital and 200 crore turnover. So which as per other day's discussion, many of them said that it is not a small company. I agree with Gururaj saying that it is a small company because the word uses or, any one of the conditions still has to be there to remain to be a small company. Because my capital is within 5 crore, I am a small company. No, it can prescribe to 5 crore. What I'm saying is I'm putting in, 50 lakh is what is stated now, but they can go up to, if it's prescribed, it can go up to 5 crore. If it's prescribed, as of now it's 50 lakh, it can go up to 5 crore. So I'm putting a higher limit, 5 crore and 200 crores. So as for us, it still remains a small company. As for many others present here, it is not a small company because you are saying turnover is 200 crores, it is a large number, so it's no but a small company. For section 92, it says 20, here it's and, it's not or, it's and, 5 crore or more and 25 crore rupees and more. So here both are satisfied, 5 crore and 200 crores, so it is not a small company. So our understanding of a small company goes wrong here, because if you go by this turnover and criteria, here it comes into a not a small company, but according to us it's still a small company. A situation 2 will come where I got a turnover of 4 crore, or rather capital of 4 crore and turnover of 2 crore. What will happen here? Because 4 crore is capital, below 5 crore, because this particular section 1 is below 5 crore and 25 crore, so it's below 5 crore, my capital is less than that, so I am not a prescribed company. So there is, if you look at this prescribed definition, company definition, and if you go into the small company definitions, there is the differences are there. So how do you look at it? Do you agree with my first sentence, first view that though you are a small company, but because you are a prescribed company, you have to get it signed by a company secretary? Or no, you are a small company, you can never get it signed by a company secretary. It is just a lacuna, so we have to, or rather small company is totally differently defined. You just have to restrict your definition of prescribed company here and see whether you fall into that or not. There is overlapping, but what do you say, sir? Depend upon the penalty is very high. I'll tell you that when I come to the penalty is very high. Better get it from the company secretary. In fact, we have not, at least I have not, I will put it that way, I have not gone through all the places wherever this company, wherever this variations are in the turnover or a capital because of a small company definition or definition specified elsewhere, or because of a level 1, level 2 companies, or rather a small company as per the accounting standards. Mr. Manohar Gupta was telling in our first meeting itself that there is a lot of lacuna in all these definitions. We have to reconcile it and come to a steady definition of small companies. Very interesting. An extract of an annual return in such prescribed form shall part of a board report. One is an annual return. You are filing as it is an annual return in one form 7.8. Then you got a board report. When other day some other speaker was reading the board report, he said an extract has to be given. It says an extract. If you go into form 7.9, you want to see what is the extract of an annual return? Give it to you here. Forms. I'll just take 2 minutes to show what is that extract of 7.9 says. That need to be a part of a board report now. And mind you, this is not only for the listed companies or big companies, this is applicable for all the companies. So even if you are small companies, all the companies in fact it says, has to have a extract of the board meeting form 7.9. And when it comes there, look at that, 7.9. It is as good as a replica of an annual return. You need to put it as a part of a board report. I really don't know what is the logic behind it. And if you go into form 7.9, more or less all the clauses, including the salaries of KMP and all the things has to come. That anyway, in the board report you have to state that. Besides all these things, in the end, the form 7.9 says it need to be certified by a company secretary. So where the logic gone then? For the board report purpose, I need to be certified again by a company secretary. There is no exemption given to me. Because I have to follow for the board report extract of Form 7.9, if you go into Form 7.9, it says that in the end, certified by Company Secretary. That means, in turn, all the companies, if you need to put this extract as the part of the board report, need to get it signed by practicing Company Secretary. Got this lacuna, or got this error, it may be an error or maybe intention was not that, I'm not very sure of it. But as the thing stands today, it's how it is. Yes. Board report is before the... Yeah, that's why. That's why they made two forms. Form 7.8 is annual report. Form 7.9. No, they use the word extract. It is not that you have to pick from the annual return. They made a separate form because of that. That they were taken care by saying separate form 7.9. Wherein, what they mean by extract is that more or less identical information is there. But they don't literally say that you have to have 7.8, form 7.8 of an annual return and copy from there. It is a form 7.9. That's why they specified a separate form 7.9. Otherwise, they would have taken an extract only without mentioning a form. But where they erred is that when they made a 7.9 form, if you go in the end, see, this is how, I think it's better to run because otherwise it will take a long time. So much of information are there. And it needs to be certified by Company Secretary. First of all, I really didn't know the logic anybody could tell the seniors who are there. What is the use of it? Replica of information. One is in an annual return if it's there. Why you have to make it an extract of an annual report by form 7.9 in a board report, and having done that, why it has to be done to all the companies? Okay, but why replica of entire thing and get into this controversy of the form where need to be certified by Company Secretary? Give information sufficient, relevant information, give it, no problem, I don't have an issue on that. Why make it almost an identical issue and it is not an extract, it is in the end to be certified by Company Secretary, 7.9. You can put it other way around that in this rule making committee, the Company Secretaries were very strong maybe. They very, very cleverly come out saying that you make it here certification. So in both the cases I am going to certify. Though Act may say that, but because of this I have to certify that now. No, it's a replacement of compliance certificate. Compliance certificate is not there, but most of the cases you have to now get it certified by a Company Secretary. That means it's as good as a compliance certificate. Because the information asked is more or less that only. Including where a default is made, where the notice is issued, where something is not followed, all things has to be set in annual return. Yes. Subject to what I told for prescribed companies, certified by Company Secretary, applicable to all the companies, but who are certifying it is different, that's all. Annual return is applicable to every company. This 7.9 is also applicable to every company. Yeah.
No, if you look at many of the disputes in the company law tribunal, and majority of which are between the family members who are directors or friends who have become promoters, after a long time some differences have cropped up. There are a number of records which are not available readily for an ordinary shareholder or a director immediately. And there have been many instances where that itself has gone into a dispute before the admission of a petition in tribunal itself. If by chance such a extract is given, they cannot at least go back on this or go for a correction or do something at the time of filing an annual return. Maybe that is the possible reason.
That's fine, but this is not the only activity which the company has done. What are the information given here? Besides, there are much more things have been done in the company. So by giving only this extract is not going to help. I got a lot of minutes of the meetings which may be filed there, which may not be copied here. I can't put all those things also in there. You can't say that put it in the board report.
At least some major things are captured here. Possibly that could be one of the reasons.
But having said that, according to me, this looks to be an error by certification by a Company Secretary.
Majority of the information what is in the annexure, it is already contained in the board's report again.
It is there. So,
it is duplication of information.
Board report we already dealt, Allah. I think it's there. I think it's a duplication. As Mr. Manohar Gupta is saying that other day we had dealt in detail about the board report. Board report again contains all this information. You. You're out, huh? Vivek, penalty. 50,000 minimum, you can go up to 5 lakh. So please mind you, if the annual return in 7.8 is not filed, penalty can go even up to 50,000 rupees beyond that 403 number of days allowed in section 403. It can go up to 50,000 rupees even for a small company, because annual return need to be filed for everybody, except that who has to be certified is different. But such companies, whether you call it as a small company, OPC and all the things, need to file an annual return. If you don't file it for any reason, ignore those companies, this itself is sufficient to wound up, in fact, 50,000 rupees the minimum. The trust is on this annual return. I'll come to one more interesting situation now. It says it need to be filed within 60 days from an annual AGM. What about OPC? Section 96 says that AGM is not applicable for OPC. OPC has to file annual return within 60 days from the AGM. How will come out this lacuna? What happens? Okay, let us not bother about it. I am not holding any AGM, so I will not file in 60 days. What will happen? So this is where probably can come out of this 50,000, at least as things looks now, come out of this 50,000 penalty, because there is no AGM for OPC. There is no question of, once the AGM itself is not there is no question of filing it in 60 days. But there is one important, I'll just come back to you, sir. But keep it in mind, there's one important section is there in, which I'm going to cover in the end. Section 122, where certain exemption is given by that section to OPCs, wherein this is not covered. Section 92 is not covered in that. It's section 98 and 101 to other sections have been covered. There it says in proviso, in 3, in 122, 3 and 4, it says that the date, in case of the OPCs, the date that the resolution have been entered in the minutes book, that is as an OPC, I entered that resolution in the minute book. That date will be considered as a date of having completed rather the content of an AGM has been met with. So I can only indirectly I can draw a reference saying that on the date when I finished entering those whatever the resolutions of that meetings in that minutes book, that will be the date of having held the AGM, and from that date 60 days. But it not necessarily be 6 months from the AGM and all that, 6 months from the date of close of financial year. So once you enter that, because that need to be, otherwise if you don't do that, there could be some other penalty. Once you fulfill that provision by entering the minutes in a minute book, by signing it as an OPC, that will be the date when your AGM has been held. That's how I look at it. Any other views? Yes, sir.
When does this fine start? Because as per 403, please correct me
Yeah.
if my understanding is wrong.
Yeah.
That gives a 270 days additional time.
30, yeah. 30 plus 270. Yeah.
270 days.
Yeah.
So beyond that, because if up to that time I can file it with the additional fee.
Correct, sir.
If I don't file up to that date, then only I think.
Correct. After that only is penalty.
After
That's what I
that
said.
only.
All when I say penalty, it is after that only.
Yeah.
Yeah.
After that only,
Yes.
not otherwise.
Yeah, correct.
Because generally everyone understands.
It's the fees. Yeah. What Mr. Nityananda is saying is that whenever I say penalty here, it is after that, as I told in the beginning also, before you came, I stressed on that point, sir. Again, I want to stress on that point. It is as per 403, wherein you are provided with 30 days to file, or whatever the number of days is stated. If you not filed within that day, here is the 60 days. You are given further 270 days as an additional fees time. Beyond that only, penalty provision will start. Unless otherwise somewhere is stated. '93, new section, welcome provision, for the only reason that Form 7.10 need to be certified by a professional, not by a company secretary. It says professional, also by a company secretary. Luckily, this form says that it need to be certified by Form 7.10, need to be certified by a professional. Professional is included, chart the content. Any change, or rather every listed company shall, within 15 days of such change, that is changes in the top 10 shareholders, file with the register of companies any change in the shares held by the promoters and or top 10 shareholders. You need to file Form 7.10. Welcome provision for the two reasons, with one, what you call hitch in it. This section is notified. That means any change in the top 10 shareholding has taken place, you need to file Form 10, but form is not notified. Form need to be certified by a chartered accountant. There is a work started already for us in these cases, listed companies. This need to be kept in mind. A new provision, section is applicable, but because of rules not being notified, I may not be able to follow this. So what will happen? Luckily, for two reasons this section is lucky. For the reason that this is the one section which doesn't have a penalty clause. If you don't know what is the penalty, they are not setting this clause. Maybe keeping in his mind, I don't know exactly. Maybe keeping in mind, this particular section has got only one section without any penalty clause in it. So even if you don't do that, there's no penalty in this as the thing stands today. However, you always have got one section. Whenever I say this section 450, Mr. Srinivasan used to always tell me in the meetings, is 450 or 420, Ravi, please be clear. There is one section 450 which says that if no provision or penalty is stated anywhere in the Act, then 450 is applicable. So whether 450 can be invoked. So this is a new section, clear? So out of the 5 new sections, I have covered one. Rest of the 4 will come in the end, almost end of my talk. Place of register, section 158 and 163. Register specified in 88 and annual return in 92, 88 register, 92 annual return shall be kept in the register of the company. It may also, it is not necessary, it may also be kept at such other places in India in which more than 1/10 of the total number of members resides. So any other place where 1/10 or more of a member resides, in such places also this form can be kept. To keep such register in such places, it need to be passed by a special resolution, passed in a general meeting and filed with the ROC in advance. That is, you need to file this form. (7.13) in rules, rule 7.13 not the form. Rule 7.13 says, though it is always known, but just to refresh your mind, rule 7.3 in one of the rules it says that these records are permanent record. That is the register of the shareholders. Register of the shareholders is a permanent record. It is stated in rule 7.13 that 8 years, 16 years, 6 years, all is not there. Anyway, for the minute rules, the minutes are were to be kept for long, forever. Now, by these rules, the register of the shareholders has to be kept as a permanent record, or register of a member has to be kept as a permanent record. A register of a debenture holders and other security holders has to be kept for 15 years from the redemption. 15 years from the redemption, the register of a debenture holders and other registers, the bond and all the thing has to be kept from the date of the registers. So these are all stated in the rules. You will not find it anywhere else. Annual return has to be kept for 8 years from the date it has been filed for the first year. That is 8 years. It will go back from the date of filing. It's not that though you are not filed up annual return, so where is the question of keeping then? It's the first if the annual return is filed, from that day onward, for 8 years you have to keep each annual return. So these are the years specified through a rules to maintain certain records. This is no change in the provision. Who can take a record, or who can, by paying certain fees, the copies of the record and all the things. The register and indices, except when they are closed, shall be open for inspection. How long it is open and all that, it will be kept open for a business hours. All that is stated. It's the same provision of the earlier provision. I'm not going to deal in detail about this. Section 95, if you have forgotten the section 164, I'm just recollecting for that purpose that it said that the register and indices and annual return shall be the prima facie evidence in any matters. It was there earlier also. It's just I'm refreshing your memory. These are all the prima facie evidences of records. section 96, this corresponds to section 166. Every company other than OPC shall hold an AGM. Is there any difference between actually holding an AGM or having an AGM? I'm asking this question now because it says every company other than OPC hold an AGM, because OPC cannot hold an AGM, but they can have an AGM at some date. Is it possible there's an X date as an AGM date and finish it off? Is it possible to say like that? I'm not very sure, I'm just putting this question now. Holding an AGM and having an AGM, is there any difference? No, that's what, I'm just asking it. So, because in OPC I can't hold an AGM, can I have X date as an AGM date and finish it off? So, having an AGM, holding an AGM, is there any distinction is there? In that case, then probably, then I can say that the section says that OPC should not have an AGM. It says OPC, every company other than OPC shall hold an AGM. That means they are not, this section doesn't bar in that event for OPC to have an AGM. I'm looking at this way now, it may be wrong, it may be corrected.
I think we have, the AGM is for the benefit of the members, and when there is only one member, what will he do? When that's the auditor has to attend, but then that he can do anything.
Because there are certain situations where auditor need to be called for. Suppose in that particular company you got a qualification, the qualification will be read. I have signed, he has signed, both have signed, both are know about it. But the act, if it says I may have to go through that particular provision again, there may be some exemption given, I'm not very sure as of now. But as Mr. Nityananda said, right now it looks like that if any qualification is there, qualification needs to be read in that particular AGM. But the only saving grace is that it need to be read by anybody. It's not necessary to be read by an auditor.
I think we'll have to go by the spirit of it.
Yeah, spirit of it.
Spirit says if the auditor has to attend, it is for the purpose of the other members to know that, well, this guy has made a mistake. And if that guy is the only guy, I don't think that it really makes any difference anywhere.
So that means it doesn't matter the hold or having, held or having doesn't make any much of difference. As the things stands today, we look at it that it's not necessary for an OPC to have an AGM, except for what I stated earlier or what I'm going to state it later in 122, 3 and 4. Not more than 15 months shall have elapsed between one AGM to another AGM. You have got a financial year which has been defined earlier. We have come across the financial year. And here it says not more than 15, prospectively let us look at it, this section how it could be operative. And this section is again notified section. Prospectively if you look at it, not more than 15 months shall have elapsed between one AGM to another AGM. I am going to have a steady financial year now. I can't change my year if the new financial year comes into picture. Then to what extent this particular clause will help me? I could see one particular provision where it could be of help. I also would like to know now, because I was not able to get an answer. If you go to the definition of a financial year, it says that if activity commences on 1st January, then 31st March of the subsequent years, otherwise it is 31st of March. Now I have got a company which was following December year end. Now I made an application to the tribunal, or I would like to voluntarily change my year to March. That is April to March. For such company, December 2000, I'll give an example, 31st March, December 2014 was an AGM for X company. I want to make my financial year as 1st April onward now, 1st April to 31st March. So can I do for that, because I want to follow it prospectively, can I have any 3 months balance sheet now? Because December that's closed, Jan, Feb, March. I want to close for March, so that from next year on I'll make April to March. Because if we strictly look into the wording of a section of a financial year, it says only for the new company, it is from commencing from 1st January, it will be the 31st of the next year. So I have got a company, because this provision anyway you have to make for a lot of companies. How do you suggest then? I have got a company which want to follow 31st of December 2014. They say, look Baba, because of this provision I want to convert myself into 1st April to 31st March. So do you want to have a 3 months balance sheet, whether it's a valid one, or you would like to go for a 15 months, whether it's possible. Whether it's a valid, it is possible. Your view please. I'm not very sure of this. So you can have a 15 month balance sheet. But if you go by the definition, it is not possible. Only except for the new company, it says. Newly formed company, it is possible. Which forms after 1st of January of that year, possible for the next year. It doesn't provide anywhere 15 months for a financial year. Yes. So financial year is defined, yeah. But financial year is defined. Financial year doesn't say, financial year is defined in such a way that starting company from 1st of January, 31st March of the next year. So what is financial year for them then? So then that means you can have a financial year of more than 12 months if you get into that situation. Possible then. I can still have a financial year more than 12 months then. One time. Yeah, one time. No bar.
I think for the sake of transition, we are talking of transition.
Yeah.
You can have all this. But beyond that, let us talk, after 4 years, all these things will be a dead discussion.
No, I was just asking, is it possible or should we? According to me, it's possible. There's no restriction on having a financial year less than 12 months. Yeah.
Yeah.
You can do it as 15
You
months.
should.
Then again,
Otherwise, how will you fall in line?
Again, it will
How
be
will you fall in line?
Yeah, for that 1 year, that's what we are saying. For that 1 year, you may not strictly follow financial year definition. You may have to come out of it and then you have to satisfy, yes, because of this, it is more than 15 months. I still may not fall under the definition. You can't say it's not a financial year, nobody can object on that according to me. You can have a shorter period, you can have a larger period also for a transition period.
In case of transitionary period, even if we keep for 15 months in the given example, I think we are complying with that.
No, that's okay. I'm not denying on that. What I'm saying is they can have 3 months also.
Yes.
You can have 3 months also,
3
you can have
months
15 months also.
Option is always open.
Yes. Having for a larger period is always better because you have to hold only one AGM less than in that event. So in such situation, this particular provision of not more than 15 months will be applicable because of that. Because my financial year is extended, so I'll have one AGM wherein this 15 months of provision could be applicable.
Not necessarily.
One of the reasons, yeah.
Yeah, one of the reasons.
Yeah,
Because
even there also another reason is there where by tribunal I can make an application for maintain the same financial year or to yeah.
No, I'll just think of another situation.
Yeah.
Maybe where I held my AGM as of, let us say, April or May 2014. For the normal, March financial year is always March for me. So my first AGM for this year I am conducting in April 2014. So then it says, next you can go maximum is not more than 15 months. You cannot go to September 2015. In the normal situation also. That could also be it.
That could also be. What, if I'm not wrong, what he's saying is that you can have two AGMs having the same financial years, 2 different years. One probably you would have a AGM in the month of April. For say 31st March 2015, you had an AGM in April 2015. For 2016, I may have it in September. In that happen, it's going to exceed 12 months and it will become 15 months. That's why this provision can be applicable in the second situation. The first AGM, period of 9 months from the close of the first financial year. It was earlier 18 months, now it's made 9 months. All other AGMs within 6 months from the date of the close of the financial year. So all other AGMs, 6 months from the end of the financial year. March, September is an AGM maximum. That's the maximum. Before that you can have it. Yeah? Where? No. Yeah, no. This slide? Yeah.
So one clarification question on the last bullet point.
Yeah.
So for the new company, where the company is formed say on 1st January, it can maintain the accounts for 15 months. I mean, it can close at the end of the March of the next year.
That's a first year company.
First year, and then it gets 9-month period for the AGM. So that means after the March of the subsequent year, it can hold the AGM at somewhere around December of that year. Is that understanding correct?
No. Every other AGM has to be within 6 from the end of the financial year.
So that's the first. That's the first one.
Yes, yes. Because one more provision I missed it here, which says that though if you read the section of the start is 96, every company shall hold the AGM in each year shall hold an AGM, it says, but they're given this exemption, except for the company in the first year, you don't have to hold an AGM in the first year. That exemption is given that. You're right.
Thanks.
National holiday, huh? Yeah. National holiday has been explained already. I'll not get back to it. There's a change from public holiday to national holiday. Already Mr. Sundaresan has dealt with that. Section 97 and Section 98, both I'll just click. That is called two enters. 97 and 98. These are the two provisions wherein it said that if annual general meeting for some reason or any other meeting of a company cannot be held for some reason, tribunal can intervene and then can give direction to hold an AGM in such manner or in such conditions and all the things. It is nothing but akin to the earlier section 186 and 167. So, I'll just one query on this. This is there in earlier provisions. What it says in brief, I told you that tribunal can intervene on an application made by a member to hold an AGM. We have come across a situation in many places that saying that I am a only member, other director is, other shareholder is not traceable, what to do. So why at all no company went into this and held an AGM and not do other transaction of which is required to be done by a company through resolutions by getting into these two sections, 186 and 166. Why was it? You could always resolve many things by this. And these two provisions, 186 and 167 came into picture, came into act in 2002. The only reason, I'll just start answering and go fast because I was told that my time is almost getting over. The only reason is because these two sections was in operation from came into act in 2002, but was never in operation. These were the section which could have been a very, very beneficial section, which was in the act, but was not in operation. Because of that, it was not meant applicable. Unfortunately, the way other advocates have told in this forum that tribunal constituting a tribunal could be a difficult task, this may not be even applicable even this act also comes. Board may call an EGM. In this section it has been stated now. Earlier, it was there in the article. Articles always said that board can call an EGM. Now that particular provision, though it is there in the article, now also in the schedule, in the table F, have been brought specifically in the act. Board may call an AGM or on a requisition of certain members, 1/10 of the paid up capital or 1/10 of the voting power, can ask for an EGM. When the EGM is called, within 21, no change in the provision, within 21 days from the receipt of the requisition, call for a meeting to be held within 45 days from the receipt of the requisition. If not, within 3 months it to be held. If at all, because when through a requisitionist the EGM is called, there will be expenses are incurred. Any reason expenses incurred by the requisition is calling the meeting under subsequent force shall be reimbursed to the requisition by the company. A provision was there, just a reminder of the existing provision. If such EGM on a requisition on a requisitionist is not called for and the expenses incurred, one, the meeting held because of the requisition is called, expenses to be borne by the company. Two, where requisition is called for an EGM, but the EGM could not be held by the company. In such situation, the expenses have to be met by such officers who are in default. And how it will be recovered, that's what this particular section says. Electronic mode, I'll come back to that, or rather electronic mode. There is a voting in electronic mode, maintaining the record in electronic mode is stated. When I go into that particular section, it's going to come later, 120, section 120, 121. At that time, I'll brief about 5 minutes. That's for the electronic mode here. One or two, nothing but section 173, explanatory statement. Yeah. Yeah. Now also is there. Now also it is there. Only thing is that earlier it was some, now it is earlier from everybody has to agree, now it's 95%. Earlier consent to be given by everybody. Shorter notice. Possible. Yes. In fact, in one of the sections which if I have time permits, I'll tell you, whether it's possible also I'm not very sure.
On this shorter notice, we'll have to recheck, because as I know, it is not possible. Anyway, we'll recheck, sir.
No, it's possible.
Yeah, I mean, let's
I'll get back to you on
I'll
that.
clarify
It's possible,
this
yes.
a bit later.
Section 102 is correspond to 173, the explanatory statement. Or the change, or rather the major change it is that any nature of concern or interest of a financial or otherwise, if any, in respect of every director, manager, KMP and other relative need to be stated in the explanatory note now. It was not there earlier in elaborate covering KMP, officer and all the thing. Now all those people have bought into this ambit when you give an explanatory note. 2%, such shareholder has a 2%, that if the interest is less than 2%, then not required to state. It was earlier 20%, now it is reduced to 2%. Earlier, unless the interest is 20% and more, then only need to be stated. That particular limit has been reduced to 2%. So if the interest is more than 2%, now we need to be stated in the explanatory statement such interest. Quorum has got a small change. Earlier it is a 2 or a 5, 2 for a private, 5 for the public. Now for the public, what they said is that with the number of members they have made a quorum. 5 if it's 1,000, 15 if it's 5,000, and 30 if it's 5,000 or more. For private company, it remains 2. And section 103, there are certain sections. These are all the sections which is operational. Section 103 is operational. According to me, see, it is ratification is nothing but a reappointment.
No, because
only thing is that if you
used, or there are 4 things which are given which are not considered.
Yeah, in one ordinary.
That speaks of appointment.
Yeah.
And if you go to the section where an auditor's appointment is there, it is for the 6 years, that is the conclusion of the first AGM to the 7th one. So if you take that 5 years, so if you take that, if it is a ratification which is required every year, so that will it be a special business under or not?
According to me, it is an ordinary business for the reason that only is my view, because though the word is it is a ratification, but there are a lot of other procedure involved in that reappointment of the audit. It is not that once you are appointed, you are automatically an auditor for next 5 years. Like a certain procedure, like the declaration of a number of companies held and all that has to be there. The word uses ratification. So you have to bring it as a point of an EGM, and in ordinary business it is. It has to be a point of every ordinary business of an ordinary resolution of a company in an EGM, according to my view. Right? Even though it's a ratification, it has to be bring to the notice of the members through an ordinary business.
Agree. Appointment includes reappointment.
Yes.
I mean, they would have used a better term. Appointment includes reappointment, is anyway told. So reappointment is through ratification. And the ordinary resolution says appointment of an auditor is an ordinary resolution.
104 talks about the chairman, no change. Chairman is the one who is elected, the same thing. If chairman is to be elected by poll, then till such chairman is elected, the existing chairman continue to be the chairman. Once the chairman is elected by poll, such chairman will continue to be the chairman. Section 105, 104, 105, all these sections are in continuity, are already applicable. Notified sections, proxies. Only in the case of a poll. If proxy is appointed, for the purpose of quorum, proxy is counted. Yeah, for the purpose of, sorry. No, for the purpose of quorum in person only, not for the proxies. But proxies have been provided, still the old power, same power continues, where only in the case of poll, he can have right, that's all. Right to vote. No. The only change in the proxy is that 2 changes have been taken as major changes. Earlier proxy, now he can represent 50 people. 50 people he can represent, that's the one change is there, and all of the provision of the proxies continues to be same. If he has got in the poll also 2 votes to be given for 50 people he has to given, he can have a different vote for different people. On a same resolution he can say yes also, no also. That's for the private company, yes. That's for the private companies, sir. Yeah. Yeah. Now that distinction is not there. If you see now this particular section earlier, for private company had that exemption rather. Now that distinction is not there. You can't have through an article like that now, because now it is Now earlier providing the section is not applicable to private company as it is stated in the articles. Now that particular distinction is not there. So proxy is applicable for even in a private company when you send a notice. Now the proxy statement has to go. How many more minutes is there? 5 minutes? Yeah. These are all the sections, not much of changes, so I'll just keep, and not much of relevance also, right, voting, you all know what are the voting rights and all the things. I don't want to go in detail about stating about voting right and all the things. I'll just touch upon the electronic mode, electronic mode of voting and electronic mode of maintenance of a record. Yeah, this is a new section. Section 108, electronic voting. This is where the central government may prescribe class of companies and the manner in which the member may exercise his right to vote by the electronic means. That means electronic means has been recognized through an act now, though it says may prescribe. So there's been it's been provided for the class of companies. Every listed company or a company which has got a 500 or more members as company will have to, or will have an option to, or will have to go by an electronic voting mode. It is a very detailed rules are there in case of an electronic mode, how it has to be made, who can be, how it can be operational. They said there are certain agencies will be appointed, MCA in its site or whoever the authorized person will have a notified agencies who will be eligible for conducting this electronic voting, how this electronic voting has to be captured, how it need to be retrieved. All those things have been stated in particular in this verse, more of a technical things, but has been dealt elaborately in the rules. So when you go to this electronic mode of voting, what are important things to note is that it has to be given to any notice on electronic voting or electronic any electronic communication has to be given to a mail ID given at least 30 days prior to the meeting by a member. If a member has given a note, his change of mail ID or a mail ID at least 30 days prior to the meeting, then only it is a valid distinct. Anything, suppose you say is given later, and if it's not served, suppose a meeting is held on today, and anything beyond, it has to be given 30 days beyond. That are the valid mail IDs given. On such ID only you have to send your notices and all the things by electronic mode. It could be an URL link also, wherein you have to say that what are the notices sent. You can tell them that it could be either in a text format, either it could be in a PDF format. What it says, what the rule says is that, and whenever you are asking for an electronic mode of voting, it also says that whatever the software to be used, that also need to be sent in that mail. It is not just that you go for an electronic mode of voting and give a URL link. It needs a specific software that also need to be sent in that particular mail. These are the certain important thing what is stated in the electronic mode of voting. It also states that suppose as not only the agency specified in the list, you have to go through them. You as a company want to conduct yourself electronic mode of voting, then you need to register in that particular portal and then do that electronic mode of voting or electronic mode of communications, be it a notice or whatever it is. A scrutinizer will be appointed, a role of a scrutinizer, how it is to be, what are the roles of a scrutinizer, that has been very clearly stated. Until the elections is over, from the date of a commencement of electronic voting, until the elections are over for that through a use of electronic mode of voting, and such result given, the 7 days period is given. Suppose today the electronic mode of voting and whatever the transaction related to that has been over, the scrutinizer has been given a power of 7 days. Within 7 days, he has to give the report to the company, and such report, whatever is given by the scrutinizer in particular given form, need to be recorded in the minutes of the meeting, signed by the chairman of the meeting. Until such time, all the transactions that taken place in this electronic mode are not the properties of the company, or the properties are to be held as in a security with the certain agency. Suppose you opened an agency, it will be the property of such agency unless it is conducted by you alone and you have registered yourself as one of the agencies. I am not again for the lack of time going in detail of what all other things stated. A lot of things of technical mode, how it is to be retrieved. Anything which is there in electronic mode should be in a retrieval form. All the thing is stated, how it is to be done, all thing, more of a technical nature. I'll dwell upon two more things, the postal ballot, and then where AGM need to be filed with the Register of Office, the proceedings in AGM, that's the new sections. Section 110, earlier it was 192A, nothing new in postal ballot, it was there earlier also. What it says that instead of transacting a business in a general meeting, a company shall, in respect of each item of business, have the central government notified. So, the transaction which has been notified by the central government, such company shall, and in respect of any item of business other than ordinary business, so ordinary business are not covered under the postal ballot, and any business in respect of which directors or auditors have the right to be heard. So, what is not covered by the postal ballot are the ordinary business, or any other meeting where the directors or the auditors has to be heard. These are the only things where it is not covered by the postal ballot, wherein central government can come in and shall direct to hold an election through a postal ballot. Again, as may be prescribed. So, what are the resolution which requires a postal ballot, compulsorily requiring a postal ballot? These are the sections which has been compulsorily to be held, shall notify. This is compulsorily held by postal ballot, by every company. Because if you look at the section 110, this is a very, very interesting provision of this particular act. There are a lot of places where rules are overruling the sections. If you go by section 110, there are certain postal ballots which shall be held, central government which shall be held by a postal ballot itself, no other means. But rules, these are the certain of the activities, but the rules has given exemption to OPC and such other companies with the members of less than 50 are exempted from this postal ballot for these activities. Understand? What I am saying is that postal ballot is compulsory for every company for these kind of resolutions, whatever is stated here. I am not going in detail, which is there in my standard material given also. These are the things which is there. But exemption is given in the rules saying that OPC and the private company which is members less than 50 need not, though the word used in section is shall postal ballot, are being given exemption to. Clear? Everybody. So if you go by the section, everybody, private company, pardon? Yes. No, that rule said OPC company with a members less than 50 says. Less than 50. No, but the section if you go, it's all listed companies. So if you go to the section 110, no, just 1 minute. I think it says with listed companies. No? Just 1 minute, Niranjan. A company, no, it is a company. So that means it is applicable to every company. But because of this exemption given in the rules, less than 50 companies, being a public or private, is going out of it. Otherwise, all of them will come in OPC and all of the companies will come under the postal ballot. Because there it is a company, not a listed company. Circular resolution, I don't think any new point is there as such. An existing provision only. This is a notified section. 112, 113 talks about again an existing section, but it talks about who will be the representation, where the governor has to represent or where a company has to represent in a meeting, or authorized person or a governor authorized person has to represent. Ordinary resolutions, special resolution, no change, identical wording, where ordinary resolution vote exceeds for and against or 3 times and 1 time, like that same, no change. Special notice, no change except the penalty has been increased. Yeah, it is the same thing. What it says, if the resolution is passed in an adjourned meeting, that date will be again the no change. That date will be the passing of the resolution, not it will not go back to the original date when the meeting ought to have been held. No change. You're not missing anything because there are no change. Only because of the time constraint, I'm not going to repeat on these sections. Minutes of the meeting. Yesterday there was a query, or the 2 days back, whether minutes of the meeting can be held in an electronic mode. Day before yesterday. Yes. Minutes of the meeting kept in an electronic mode is a valid record. A rules has prescribed how it need to be maintained. Each page need to be digitally signed. If you maintain in electronic mode, it will be how the signature has to come, what the set is digitally signed. The digitally signed each page of a meeting is a valid electronic meeting record. They also have gone away with in the rules that earlier used to make a minute, print a minute and used to paste in the minute book. That has been done away with. You can't do any more pasting of a meeting minutes in a minute book. That has been done away with. Which one? But it is of no more a valid one. This is what I just spoke about. Electronically maintaining of the documents, records. It talks of records. When it talks of records, you have to go to the books of accounts records. There are two definitions, books of accounts and records. That means how those things have to be maintained. There is added the word electronic mode. How this electronic mode is to be maintained has specifying the rules, which generally what we are doing, forget about the minutes, generally otherwise what you are maintaining the books of accounts is what they are talking about, how it is to be maintained. It has to be retrievable at any time in a paper format, in a readable format, readable paper format. That's what the main crux of this electronic mode of maintenance of records. Whatever you maintain in electronics, whenever it's asked for it, it need to be given in a readable form to a member who asked for it. Then is an electronic mode of maintaining of a record. The very, very important point what is stated in the rules is that whenever you are maintaining an electronic mode of records, it need to be taken, the backup need to be taken not less than 2 times a day. So, at any time, tomorrow if somebody comes and says that no, I was electronic, it got erased, corrupted and all the thing, no more a valid explanation because the rule says that 2 times a day you need to take a backup. That's very important to note. New section, section 121, report of an AGM, applicable to every listed company. So here it was applicable to listed company, I was a little confused there. It is applicable to every listed company. Every listed company shall prepare in a prescribed manner a report of an AGM. So it was not there. What they say is that, in brief, after the AGM is over, within 30 days, a report of an AGM need to be filed with the register of companies now. And this is an operational section now. Oh, I'm sorry, no, 121 is not an operational section. 121 is not operational. No, I think 121 is not operational section. I'm sorry. It is not. So this is what the requirement is. Applicable for every listed company shall prepare a prescribed and a report of AGM confined so and so within 30 days need to be filed. The very last clause, very important. Company will be fined 1 lakh rupees to 5 lakh rupees if such report is not filed within that prescribed term, subject to 403 and all the thing coming into picture with the register of companies. So every listed company need to file it once this 121 becomes operational. A separate report now. It's not that you're done with the AGM and just keep quiet. So the last section under my chapter, I've been a little hurrying in the last few slides because of the time constraint. The last section is section 122, which talks about what are the sections which are not applicable to OPC. It says that section 98 and section 100 to 111 are not applicable to OPC. So 98, 100 to 111, that means 100 is EGM. EGM is covered, but 96 is not covered. 96 is AGM. 92 was annual return. Annual return is not covered. So 92 annual return, 96 AGM, but because maybe in the AGM, 96 they said in that particular section itself it is not covered, OPC has not covered, maybe because of that they are not specifically stated here. These are some of the main important provisions which is not applicable to OPC. However, they said that, as I told you earlier, whenever you make a resolutions are there, resolution of a meeting and resolution of a board meeting, even though it's a OPC, it need to be entered in the minutes book, and that date, it is to be construed as a date when that particular meeting has taken place. When is entered, whatever the resolution you pass, entered in the minutes books. They need to maintain a minutes book. The day when that entry has come in that minutes book is the day when that particular activity has taken place or that action has been taken place. That's how the sub-provision of 3(4) of 122 talks about. These are briefly the section from 88 to 122 covering 35 section and about more than 120 rules and provision, about 20 forms and all that thing. In the given limited time, I try to cover almost all the sections. I may be a little faster in the end. Do pardon me. As always, I end my talk thanking my senior partner, Mr. Ram Subramaniam in his absentia, who has been guiding factor in my practice. Thank you for a very patient hearing. Thank you.
Thank you, Ravi. We always have a problem of quorum in our workshop. We have the maximum people just before, 6 o'clock. So therefore, I would like to make a couple of announcements. Tomorrow, if we are having a quorum just before 6 o'clock, it would not work. And surely, our program is going to start at 9:30. Okay, and it ends up with a lunch at 1:45. The first session is going to be on nothing but auditors. In fact, Mr. Nityananda asked a very beautiful question. I will twist the question in a different way till Lakshmi goes us to give us dividends. Okay. Lakshmi is giving us dividends today.
So Lakshmi, going out, Lakshmi.
Okay. If you're ready. Okay. As she is ready, he asked where ordinary resolutions, special resolutions. Whenever ordinary resolutions you have to think of only 4 people. One is Nityananda, who will be talking on auditors. One is Dr. Ravi, who talked about directors. One is financial statements. You saw on the other day financial statements being discussed. And the other one is directors, auditors, financial statements, and Lakshmi. Okay, so we have Lakshmi to talk to us on dividends. If you are ready, we are ready to hear, and we are here to receive dividends.
Thank you. A very happy evening to all the members present here. The next few minutes, I am going to live my dream. It was my dream that I shared the dais with my teacher come partner, Mr. Vijayaraja, and I thank the Bangalore branch, Mr. Acharya, Ravi Prasad and Guru Prasad, my partners, who have helped me be here today. Already when we started the presentation, Mr. Acharya stole my slide. He said the shortest definition, which is, we all know, section 235. Then my talk is supposed to be for 30 minutes, but I know you are all eager for the break after this. I must tell you a secret. Actually, when I was doing my GMCS, I made friends with the people who cook in the kitchen. I specifically told them, until I step down from the dais, not to serve. So you'll all have to wait till my talk gets over. And Chapter 8 is one of the small chapters in the New Companies Act. And of course, I am the youngest speaker standing before you all today, and no points for guessing my age. And also the shortest speaker, all of 4x10 standing before all of you. And hence, I would like to tell that dynamites come in small packages. And one more secret I'll tell you, there is a stool below me so that all of you see me, and also that I can see all of you too. So I thank the Bangalore branch for thinking of everything before I came onto the dais. Now dividend, though the shortest section is the sweetest too. And also I am very sweetly placed before Mr. Ravi Prasad, before Mr. Vijayaraja and after Mr. Ravi Prasad. Now, what is in it for me, asks a shareholder. The smallest section in the Act, yet the entire corporate world gets their life through dividends. Now, all of it surrounds on dividend. Be it the return on investment, the P ratio, the share prices and EPS, and a relationship with a shareholder is defined through the dividends in the corporate world. So my agenda for today's talk is, I'll just briefly give you a synopsis. of the erstwhile act and the current chapter. And then why were these changes done? Probably a perspective from my side to get you a perspective, and some ticklish issues where I get you all to think on this change in the new act. Now, section 123 of 2013 Act talks about declaration of dividend. And this was dealt earlier in 205, 205A3 and 206. So these three have been clubbed into 123, 123, and 124 talks about unpaid dividends, which was the erstwhile 205A and 205B. And section 125, which was nothing but 205C of the earlier Act, specifically deals with investor education and protection fund. Now let's go to 126, which talks about the right to dividend and right shares when it has to be kept in abeyance when there is a dispute on transfer, which was the 206A of the Act. And then 127, which earlier was the penalty section under 207, now also talks about punishment for a shareholder, punishment for the company when the dividends have not been, when the compliance has not been met as per this chapter. Actually, he's distracting me, so I'll just smile and get a good photo. So, 123.1, let's straight away get into the section. 123.1 says, okay, let's get to the basics first. How is dividend declared? Out of profits of the company. So, profits for that year, or profits of the earlier years, or out of both. And there's also this provision which tells that out of the grants specifically given by the central government, dividends can be issued. Now there is a star point here. What is it? I can declare dividends out of my profits only after I have taken depreciation into consideration. Now 123.2 tells that depreciation shall be as per Schedule 2 of the Act. Only for this section alone, the entire Schedule 2 has come into picture. So we have no other mode of calculating depreciation except Schedule 2. Now, by reading this section, let's look at a practical illustration. Now, the revenue from operations of the company is 480, expenses is 137, and the EBITDA is 343. Now, depreciation that I've computed as per books is 164, and the tax expenses I've decided to give, the tax expenses coming to 10. So, profit before transfer to reserves here is 169. Now, I decide out of this I'll transfer 160 to the reserves. So, profit for the year after doing this whole steps of computation is coming to 9. And depreciation as per Schedule 2 of the Companies Act is 162. So, profit available for distribution is 11. So, how do we arrive at that? 9, add back the books depreciation, reduce 162, and the dividend that's available for depreciation is 11. So, the first proviso here says the company may transfer appropriate percentage of profits to reserve. This was not the case in the earlier Act. It specified a percentage to be transferred, but here they have left it to the discretion of the company. So what is the implication of may here? It is very important to see. Now the ownership of transfer of reserve is on the board of directors. Earlier, as I said you, the Act specifically told. But now here, it is up to the board of directors to decide how much is the percentage that they need to transfer. Then board can control the flow of money by increasing the percentage of transfer to reserve. So if the board decides that they do not want to declare dividends, they can transfer the entire amount to reserve. So this could be one of the observations. Now, what is in it for me as an auditor? The line item in P&L account. It is, the appropriation made to reserves is one of the line items. So I need to look into it. Then there is impact on sustainability. I came across this interesting observation where Microsoft and Infosys, when they started in their earlier years, they were not declaring dividends. They were flowing back the entire money into the company so that they could hold it for expansion. Now, because of this not being met, the sustainability is in question. And an important question is on the going concern. Now, if the dividends have not, if the entire dividends has been paid out to the company, then the going concern could be a question. So now, what we have to see is that the auditor's role as at present cannot be determined just because of this may, and this would evolve over a period of time. Let's come to the second proviso of this section, which says, in case of inadequate profits or absence of profits, declaration shall be made out of reserves as per the rules. Hence, it is important for us to here go through the rules, which is, we read second proviso with rule 8.1. What happens in case of a loss? A company may declare dividends out of accumulated profits earned in previous years and transferred to reserves in the event of inadequacy or absence of profits. So there are certain conditions that I need to satisfy here. So let me look at the practical illustration. So I've given the dividend rates for the last 3 years, where the paid up share capital is 25 lakhs, the free reserves is 10 lakhs, and there's a loss of 0.5 lakhs. So clause 1, that is the condition 1, says the rate of dividend should not exceed the average of 3 years percentage. So when I compute the average of last 3 years, which is 9 plus 11 plus 10, and divided by 3, it comes to 10% of 25 lakhs, which is 2.5 lakhs. And then the second condition here is that the dividend shall not exceed 1/10 of free reserves plus the share capital. So 1/10 of free reserves plus share capital, when I add it and divide it by 10, it comes to 3.5 lakhs. There's also this third condition which I need to take care, which says write off the current year losses. So current year loss is coming to 0.5. So when I write this off, the balance that is remaining is 3 lakhs. Now the fourth condition also which I need to take care is that whatever amount I need to transfer shall be greater than 15% of capital. So the balance remaining in free reserves shall be greater than 15%. So when I do this calculation and free reserves is 10 lakhs and I reduce 2.5 lakhs out of this, I'm left with 7.5 lakhs. So the last criteria, where 15% of PUC where I'm supposed to meet of 3.75 lakhs, I'm meeting because I'm left with 7.5 lakhs in my reserves. So having understood this, let's go to 123.3. The definition of dividend includes any interim dividend. So this section states a board of directors may issue interim dividend during financial year out of surplus in P&L account and out of profits of the financial year in which such dividend is declared, except in case of loss in the current financial year up to the end of quarter preceding the date of declaration. Such rate of dividend shall not exceed the average. So this average is coming out every year. I'll deal with it towards the end, why it is important to see average. Now in this scenario, I have given a loss in 2013-14. So I'll go back to the last 3 years average of profits, which comes to 10%, and such dividend shall not exceed 10%. Quickly running through the other provisions in 123, the provision says that I need to deposit in a separate scheduled bank account within 5 days from the date of declaration. So I was calling the assistant vice president of the Axis Bank and I asked him, do people really open an account like this? He said yes. Previously we had opened an account telling XYZ Limited dividend account 2013-14. So that is how the dividend account will be opened by the bankers. Then who is the rightful owner of this dividend? It is the registered shareholder. I need to pay dividend to the registered shareholder, except I can capitalize my profits, that is issue bonus shares to the shareholder or pay any unpaid amount which is due to him. In that case, I don't have to give dividend and use it for bonus shares and unpaid amount. Then dividend paid in cash may be through check or electronic mode. Electronic mode is the new thing which we've all been hearing, which is in the 2013 Act. Now 123.6 says, which is again new, if I've defaulted in payment of repayment and acceptance of deposit, until such default is made good, I cannot declare dividends. So 124 deals with unpaid dividend accounts. So this 124.4, I have a chart in the next slide which tells how to go about it. I'll just explain that to you quickly. The revised provision says the company may declare dividend. The company has declared dividend on Jan 1st, 2013. So we read that it needs to be transferred within 5 days to private limited dividend account for the year. Such dividend must be paid within 30 days to the shareholder, which comes to 31st Jan 2014. And in case there is an amount left in the dividend account within 7 days of such expiry of 30 days, I am supposed to transfer it to unpaid dividend account. My logical question here was, see, obviously anything that is remaining in the dividend account is unpaid dividend account. Why not hold it as such? But we have to follow the law which says unpaid dividend account, which is by 7th February 2013. This is a new provision which says Within 90 days of such transfer, the company needs to prepare a statement containing name, last known address and the unpaid dividend amount. So to give transparency, they have brought out this provision which is until 8th May 2014, I need to come out with the statement. And this statement must be published in the website of the company and any other website approved by the central government for this purpose. Now this again is in contradiction with the rule prescribed for this section. The rule says website of the company or a central government approved website. But here it says and. And hi Guru. And Guru is here, so I'm so happy he could make it. Then the next provision, the next thing that we need to see is unpaid amount lying in this account should be transferred to IEPF after 7 years. So finally the amount that remains unpaid for 7 years needs to go to a IEPF account. The interesting provision here that's come up and a new provision is the shares relating to the unpaid dividend account also needs to be transferred to IEPF account with the details. I will deal with the importance of this in the next slide. The last point in this section is that a company is punishable with a fine of 5 to 25 lakhs and every officer of fine up to 1 to 5 lakhs. Now some thoughts on shares relating to unpaid dividend account getting transferred. Now who is the transferor in the case? The shareholder is the transferor. But when you decide to transfer the shares also to the unpaid dividend account, the company is transferring it to the IEPF. So where is the contract? There is no transferor or transferee here. Further the issue comes up, who is going to pay the stamp duty on such transfer? We need to deal upon that. Then is IEPF holding interest? If yes, should we take care of section 187C of the old act, or as Mr. Ravi was speaking, section 89, where I need to hold the shares in beneficial interest? These are the questions which comes up with the practical difficulties of actually transferring the shares and probably then transferring back. So there would be a tough time on this. I just run through this. 125 is the section which talks about Investor Education and Protection Fund. There is also, it gives the details of what are the amounts that can be credited to the fund. And it also states what is the utilization of this fund. So, and it also prescribes the procedural aspects as to how the central government can constitute this, etc., etc. So we can easily skip this. 126 is the same old act which was there earlier. There has been no change here. Where what this act says is, what this section says is, where a transfer instrument has not been registered. Let's say A transfers his shares to B, and he has executed the share transfer form and he has given it to the company, but the company has not yet placed it before the board. Then what happens to such amount? The law says transfer the dividend to unpaid dividend account unless it is authorized by A in writing to be transferred to B. So that is what this says. And in case of issuance of right shares and bonus shares, until such time it is decided who is the transferee, it needs to be kept in abeyance. And the only section out of this entire chapter that has become effective is section 127. Has to be the punishment and penalty section, which we are hearing very often. Now what this prescribes is, in case the dividend is declared and not paid within 30 days, and the defaulting officer knowingly a part of default, is liable to a fine, to imprisonment which is not extending beyond 22 years, and with a fine of 1,000 per day. And the company is liable to pay simple interest at 18% per annum on the amount not transferred. Now there are certain exceptions when this punishment is not applicable. By way of operation of law, the dividend could not have been transferred. Then the shareholder's directions not complied with, and the same has been communicated to the shareholder. In that case also the punishment does not become applicable. Then dispute regarding right to receive dividend. So when there is a dispute going on and it's uncertain that who is supposed to receive, then also it is exempted. Then dividend adjusted against sums dues and not due to default by company. So in such cases it is exempt. Now the most interesting part is why the change. Let's get a perspective on why probably this change was made. As I was mentioning to you, I came up with this rate of dividend, rate of average dividend everywhere, and I was Googling it. I found that there is a Lintner model. Lintner model says the shareholders always prefer that there is a stability in the rate of dividend that is issued. That is why it is said that, I felt that it is said that the average rate has been prescribed in the Act. And one more thing here is, in the 2013 Act, interim dividend rate shall not exceed average profits of last 3 years. The business sustainability for loss companies is examined so that the promoters cannot withdraw profits when other obligations are there. So when there is a loss, there are certain restrictions so that the promoters don't eat away all the monies. Now, 123 of 1956 Act said dividend could be paid even if deposits not repaid. However, in this Act, in the new Act, it says we cannot pay until the depositors are repaid. So this is basically a section to give protection to the depositors. Now, mandatory transfer to general reserves was applicable in 1956. In 2013, it says the company's discretion to transfer and it may transfer. So, onus of responsibility is on the company and not the lawmaker. So, they have straight away shifted the onus to the company. Now, auditors might need to check adequacy of this discretion of the company. Depreciation earlier was as per Schedule 14 and higher rates was possible. However, now we have to specifically stick to Schedule 2 where a higher rate of depreciation cannot be used. Now, this blocks the companies where depreciation is charged higher to avoid dividends. So, this is a measure to basically help the minority shareholders, which is what I felt. And again here, 1956 Act said central government could allow dividends without depreciation. But that is not possible in the 2013 Act. Why the change? This is to give a better financial transparency and not involve a regulator to decide the financial thought process of a company, which is a very prudent thing. Now, 124 did not have a provision on the 1956 Act to disclose the details of unpaid dividend to the shareholders on the website of the company. While this is a very welcome move, what could be an issue is the privacy loss, because on the website of the company you are going to place the details of the shareholder who holds shares and the amounts that is due to him. So the privacy loss could be questioned. I actually went through the forms and there is no such login mechanism where the shareholder could see only his details. That I could not understand. So over a period of time we will know what is it that the rules will notify and practically what would happen. Under the 124 Act also, in case of unpaid dividends, transfer even shares to IEPF, which I was telling you is the new provision. Investment was done without KYC norms a decade ago. If you go back 10 years, you can see that the KYC norms and the banking norms were not so stringent. Now, dividend transfer is electronic to a bank account. Hence, issue of KYC norms will be addressed now. Further, to curb Benami shares, I feel this provision could have been introduced. Now, the last question to ponder again here is, if there is a loss in the accounting year and the same year there is a merger, and if dividend has been paid, what should be the average rate taken for the preceding 3 years? So this again I will leave with you a question to think about, and I come to the end of my presentation. It was a really short and sweet session, and because I know you are all eagerly waiting for the snack break, and there were not too many changes, and which was all easily understandable, I ran through the presentation. I once again thank all of you for the patient hearing, and any questions we may have, we'll take it up after Mr. Vijay Raja's session. Thank you.
Thank you, Sri Lakshmi. Smallest and shortest is what you started, but I can say you are sweetest and most confident. More confident than most of the 17 speakers. That's why you got a special applause. I was only scared because I had not heard her speaking before, but now I should say, Companies Act has reserved one women director. I know that there are a lot of women speakers here. I know Aishwarya Nityananda is there, Rashmi, Manohar Gupta's daughter. We have all had them for the Schedule 6. Now, if this is the quality of the women speakers, I am afraid there may have to be a reservation for men speakers. No? So congratulations, you did a very good job, and what I liked most was your confidence and your smile for that photographer, which I can't do what you did. And then the PowerPoint presentation itself, fantastic presentation. Absolutely. So she has done her psychology masters, I am told. Maybe she has the audience psychology captured. But one point I would like to say is, you mentioned that depreciation. There is issue with the depreciation. You can't charge higher depreciation than what has been told in Schedule 2, which I have my own views. If you get into the Schedule 2, it permits for higher depreciation being charged. Nevertheless, the Lintner model which you used, now I will have to go back and Google. Thank you very much. We'll meet after the tea break.
I profusely thank
Sorry, sir.
and C.S. Srilakshmi for giving a terrific presentation on management and administration and enriching us with new insights of Companies Act. Now, I request C.A. Shambhu Sharma, past chairman of Bangalore branch, to come forward and present a memento to our speakers, C.A. Ravi Prasad and C.A. Srilakshmi. First lady. Thank you, sir. Now we will break for tea and reassemble here exactly after 15 minutes, that is 6:30. Thank you.